let's go straight to the bank, since
Sure.
it was the big story of the day. We've covered it already, ANZ, with a few of the other brokers and what they've said. But I guess at the end of the day, putting what we know from ANZ and what we know from NAB, how would you rank those results, and does it justify their share prices at the moment?
Look, I think all of the banks at the moment seem to be a little bit expensive. The best performing bank is the CBA by head and shoulders. The reason I say that is because they were able to buy Bank West from a distressed seller, which has given them a real boost to their return on equity. And I note that you mentioned one of the brokers talking about the normalised return on equity for the NAB. The NAB, the ANZ and Westpac's actual return on equity, not normalised, but their actual return on equity is going to be in the 11 to 12% range for the next couple of years, and whereas the CBAs will be in the 22-23% range. Now, as you know, I value businesses based on return on equity. CBA's valuation is considerably higher as a result than the other three banks, but for all of them, they're not cheap now. In fact, the CBA's share price is about my valuation for 2011. So there are no bargains, it seems, in the banking space. Having said that, I think it was a couple of appearances ago when I came on your show, and I said, what a great industry to own on an island. You know, you want to own a bank. When John Simons came into Australia and started Aussie home loans in the mid-1990s, net interest margins for banks were about 400 basis points, or 4%. Now, since then, they've headed down towards 200 basis points. But the global financial crisis has basically wiped out, it's been a tsunami to the competition, completely wiped them out, and you'll start to see that net interest margin creep up. So they're a bulletproof franchise to own on an island. You really want to own the banks, but you want to get them at the best price to boost your returns.
Myer at this price, $4.10. From memory, I think when we were talking about what Myer should be valued at, is that still expensive on your numbers?
Yes. In fact, I value Myer based on its present performance at $2.90. And in 5 years' time, the value rises by about 6% a year to $3.90. So the price that you're paying today of $4.10 is above my valuation in 5 years' time. Now, people might think, well, that's absurd, Roger. There's very smart people out there who are buying these shares, like institutions and so on. Well, the institutions, many of whom I used to work for, they bought into the capital raisings of ABC Learning Centres. Yep. They also bought into the float of Virgin. Virgin listed at $2.50, it now trades at circa 50 cents. The values of business, the way I calculate values, I know are a little bit conservative, but I also know that because price isn't an input into that calculation of value, it's purely based on the performance of the business, that they're reasonably good. And so ultimately, share prices can go a long way from my valuations because of popularity. Yep. But over long periods of time, companies age, popularity wanes, and then the share price will follow the value.
Putting aside your theory of valuations, when Myer actually lists and fundies start, trading it,
sure,
will it have an impact on David Jones? Do you foresee, some fundies switching out of DJs into Myer?
Yeah, look, they may, if they didn't get enough stock, that would be true, but my understanding is that some retail brokers were actually offered the opportunity to participate in the institutional book build because there wasn't enough demand in the institutional book build. So yes, the answer would be yes in theory, but in practice we just don't know. There's also the possibility that you'll get pairs trading in them, where some fund managers will sell DJs because it's slightly more expensive on a PE basis and buy Myer. But I ignore PEs. I'm not interested in the PEs. I'm interested in the business, and the business is worth $2.90, tops $3, and you're being asked to pay $4.10.
And joining us on the line is Gerard. Gerard, appreciate your time here on Market Moves. Let's go straight to your picks. Your 3 picks are for your fantasy portfolio. You've picked Macmillan Shakespeare. You've also got Monadelphous on that list, and CSL. Gerard, we've actually got some very good news. While you were speaking, Roger was showing me his notes and his research notes, and there's 2 letters in common with each of those stocks.
They're all what I would describe as AA stocks. We have a little ranking system that I run for companies, and all 3 of them are AA. In fact, if Gerard sends me an email or goes to my website, he can send me a CV and I might consider him for a job. They are, on top of everything that Gerard said, let me say this, 3 businesses that are actually trading at slight discounts to their valuations this year, and their valuations in 2010 and 2011 are rising significantly. Now, your viewers can't see this, but you can see we've got 45-degree lines for the valuations of these companies over the next 2 years. So you want to buy businesses at cheaper than what they're worth, and you also want to buy businesses whose worth is going up significantly over the next couple of years, and that certainly seems to be the case with all 3 companies. So, Gerard, send me a CV to roger@rogermontgomery.com and we'll consider you for a job.
Okay, let's now, though, take a look at your 3 stocks that you want to kind of put in your own portfolio. And the interesting thing is that you've actually picked one which Gerard picked as well.
Yeah, I've got Macmillan Shakespeare as well for the same reasons. JB Hi-Fi is the other one, and I know it's, you know, people are going to get sick of me talking about it, but quite frankly, its value today is about its price, but its value next year is $27 or thereabouts, and its value in 2 years' time is $30. So my hope would be that the share price of JB Hi-Fi actually falls significantly over the next few months if there is indeed a correction, because that gives us the opportunity to buy more of a great business at a cheap price. And I like the CBA. I think it's expensive. I wouldn't buy it at today's prices. I'd prefer to buy it cheaper. Having said that, I already own it. But if I didn't own it and I wanted to buy a bank, it would be the CBA. It'd just have to be a little bit cheaper. You know I'm no good at predicting these things, but let me state some facts. In the last 6 months, the market has gone from, and I don't use PE ratios, but I'll give everyone their fix, you know, because they seem to like PE ratios. The market has gone from historic low PE ratios on a trailing basis to historic high PE ratios. In fact, the S&P 500, just before this pullback began, was trading on a trailing PE ratio of about 27. That is the highest since at the first month of the recovery. That's been the highest since 1954, which is extreme, you know, in terms, and even the forward PE ratios seem to be very, very high, and so a pullback is certainly possible, even deeper than what we've seen. I don't know. What I do know is there aren't many companies that are cheap that are good, and in that situation, what you need to do is keep your money safe and keep it in the bank until you find great businesses cheap.
One trend that I've noticed over the past couple of days anyway is this shift towards defensives. And when we look at the stocks that push the market or try to push the market higher today, the top 5, CSL, Telstra, Sonic, Transurban, Foster's, all, you know, traditional defensive.
It's funny, you know, if a business loses $700 million because the management overpay for an acquisition, is it fair to describe that as a defensive company? You know, that's Foster's, and I don't think Foster's is a defensive business at all. I in fact think that they way overpaid for South Corp, and there's probably still more losses to come out of that acquisition. So I wouldn't describe that as defensive. Yes, you're right. There seems to be a bit of coincidence that the companies that have gone up are described as defensive. But I think the best defence is buying great businesses. Now, some of them are. CSL is a terrific business. Telstra, I think, how do you value Telstra? How do you know what's going to come out of this? Once the legislation goes to the Senate for debate, who knows whether it's going to be passed or not? And if it is, what's it going to look like? You can't really value that. And if you can't value it, it's very hard to call it defensive. But I appreciate everyone else out there is. I just don't think that's a particularly good business. And one last point about Telstra, you've had mobile phone subscriptions go from 8 million to 22 million in 10 years. You've had internet penetration in households go from 20% to 80%, and pay TV, which this station is on, go from 0 to 48% penetration, and yet Telstra's profit is the same today as what it was a decade ago. That, to me, isn't defensive.
Okay, Roger, we got through it. Thanks for your time.
Pleasure, mate.
Roger Montgomery.